If your company already buys leads or runs paid advertising campaigns yourself, you'll know the cost per lead only tells part of the story. You also need to know whether the leads meet your criteria, whether your sales team can actually reach them, how many of those actually move forward, and what those customers that actually end up paying are worth. We build paid advertising campaigns for business lenders, debt relief companies, insurance agencies, and other high ticket service businesses. In this video, you'll learn the 3 rules that we use to build and evaluate profitable lead generation campaigns. I'm also going to open up actual campaign assets and show you the ads, the qualification process, lead delivery and sales data, and how that determines whether or not a campaign is worth scaling or turning off. Most of the performance data that we'll be showing you comes from our business lending campaigns where we have the deepest operating history. I'll also show how the acquisition model changes for debt relief and commercial insurance, where the qualification criteria, the sales cycle, and the economics are different. Now, your campaign has to be built around the opportunities that your company can convert profitably. Now, let's dive into it. If you don't know me, my name is Isaac Wood. I am the founder of Fast Qualified Leads. We build and manage lead generation campaigns for financial services companies with visibility well beyond the initial lead that we generate. Talking about contacts, applications, approvals, funded deals, and actual revenue into the business. And most of the performance data, as I mentioned, is going to come from the business lending. The other 2 verticals, debt relief and commercial insurance, are newer markets for us. So I'll clearly separate, what we're already measured from where we're currently applying and testing in those markets. And so let's just start with the first step, the first decision that every lead buyer needs to make. What exactly counts as a qualified lead? First, we always want to define what a qualified leads means for your company. And so every campaign needs to answer this one specific question. Would your sales team genuinely want to speak with this lead? If not, that lead should not be delivered, and you should continue to be optimizing your campaign. As an example, if you're a business lender, you might care about things like annual revenue, time in business, monthly deposits, credit, and if they have any defaults. If you're a debt relief company, you might care about their actual verified unsecured debt amounts, eligible debt types. Are they currently enrolled in another program elsewhere? You might also want to know their employment and their payment ability. If you're an insurance agency, you might want to understand the industry that the company is in, their revenue, their payroll, their employee count, where they're located specifically in terms of their geography. And you might also want to know their renewal date. If they're looking for a new policy, if they're looking to change their existing policy, right? Let's go into how 2 different lead profiles might look. Let's take 2 businesses. They have a similar profile in terms of their revenue, right? $300,000 in business A and business B. They've both been in business for 18 months. They both have $25,000 per month in monthly deposits. That means they're making $25K into their bank account every single month. Key difference here, 580 credit in business A versus 740 credit in business B. Business A has some recent payment issues on their existing financing, and business B has no recent defaults. So the main difference here, same revenue, same time in business, same monthly deposits. The difference is their credit profile. So that's going to be a lead that looks similar on the surface, but is very different underneath the surface. Now let's talk about another example in debt relief. 2 consumers, as an example, might report having $40,000 in unsecured debts. So what does that actually mean? For a consumer A, they have $40,000 in self-reported debt, and consumer B has the same amount. Consumer A, if they've actually done a credit pull, you might find they have only $8,000 in verified eligible debt. The next consumer B, actually has $36,000 in verified eligible debt, verified by a credit pull. Consumer A is enrolled in another program. Consumer B is not enrolled in another program. As it goes, on the surface, they might look the same, but underneath, they're very different because they actually have different debt amounts. For the commercial insurance example, let's just take two businesses, business A, business B. They both have 25 employees, $1.5 million in payroll. They have renewals. This is where it differentiates. One is in 30 days, the other is in 9 months. Business A, they have clean claims history. They're not actively making claims. Business B has recent multiple claims. Business A is well within the risk profile. Business B is falling outside of the agency's risk profile. So, same industry, same payroll, different timing in terms of their renewal and just general risk profile. What this means in general is that a lead isn't just qualified because it checks a single box. It is qualified when the full profile lines up with the kinds of opportunities that your company can realistically convert and serve profitably. And that definition should clearly be agreed upon before the campaign is launched. If you're not doing this, you're going to be dealing with a lot of junk. It's going to cause your sales team to be dealing with people who aren't good fits, wasting time and not closing as many high quality customers as they should be, wasting time with bad fits. So, next step here. We want to keep the message consistent across the funnel. The prospect should understand the same offer at every single stage that they're interacting with you and your business, right? That means your ad needs to be consistent with your qualifying form and your funnel, your landing page, your form. Once they've actually submitted that information, they've booked a meeting, they've taken the next step, you should have a confirmation page that is consistent. And then the sales process also needs to be consistent. So each step should prepare them for the next one. Pretty simple. The lead sees several different parts of the campaign before actually speaking with your sales team. Again, advertisement, landing page and the form, the qualification questions, the confirmation page, the first call, text, or email that they receive. Let's talk about how this actually looks across a funnel specific to business lending. So, if we go over here, let's just assume that this is an ad. Small business loan ad. As a disclaimer, this is just an example for illustrative purposes. This is not legal. This is not financial advice. This is definitely not an offer. So, as an example, this ad says business loans may be available up to $1 million. Funding may be available quickly, right? That then leads to a landing page. Once the audience has clicked on the ad, they're now on this landing page. Basically, it's suggesting working capital for payroll, inventory, equipment, and expansion. It needs to be consistent. As you can see, if you look back at this ad, it's similar, right? $1 million, right? Talking about funds you need in less than 24 hours, funding in less than 24 hours. Very consistent, showing exactly the same messaging across the board. Now, if they select apply now, they'll be sent into a questionnaire. Now, for this questionnaire, you need to uncover information about their business, right? You need to understand specifically how long they've been in business, their annual revenue, their credit score, how much funding they need, what are the funds going to be used for. This is just an example. But again, if you're asking for questions here, you're actually trying to get them to apply for more information. It, again, needs to be consistent. The next one here, the thank you page. Once they've actually taken the action, they're then sent to a page that reaffirms their action, continues the consistent messaging through the process. Hey, take the next step, not just, hey, you're done, right? You're specifically showing them, hey, continue through. Then we have the next step, which is in this case an SMS, right? You've submitted information. When can we speak? This is an email text that we use. Hey, this is Isaac from your business name. You submitted information about our programs. I have a few minutes to chat now. If you're available, you can chat later or even tomorrow. What works for you? And then, you'll see the reply, right? The last step in the sales funnel, right, is the actual sales call. So they've been pushed through the funnel with the consistent messaging. When you get on the call with a salesperson, and they ask you, hey, what's your current revenue? They're continuing to verify that information, review the information, collect those documents, and discuss the available options. They're going to be much more likely to close versus if the original ad was telling them something completely different, immediate approval, or get $100 million, and they're only expecting to get something up to $1 million, it's going to be very incongruent, and it's going to cause confusion, lack of trust, and ultimately it's going to ruin your close rate. So that leads me to the inconsistent message funnel example. So again, not a real ad, not a real offer, but let's just say this is a ad for loan amounts up to $1 million. Get approved instantly, get started now, big bold letters. It really communicates something. Specifically, get approved instantly. The next time they actually talk to your salesperson, they're saying, hey, you got to get us some information, apply, submit your application, submit your bank statements. We'll complete it, we'll get it to underwriting, and we'll be off to the races. It's going to cause confusion because the lead clicked on the ad under the assumption that they would be immediately and instantly approved, right? So this, not only is this going to have an issue with the sales process, it's just truly just not compliant advertising at all. And first and foremost, you need to maintain compliance with all legal laws in your state, in your country. So the next one here, let's talk about connecting the campaign data to real sales outcomes. So as an example, the cost per lead tells you how efficiently the campaign generated a form submission in this case, right? Somebody sees the ad. Not everyone's going to necessarily click on the ad, but those people who do click on the ad found it interesting enough. Once they've clicked on the ad, they'll get to the landing page. They find the landing page interesting. They'll click on the form. They'll fill out the form. There's different steps throughout the form. There's going to be drop off at every single stage. This is ultimately going to roll up into your cost per lead. It does not tell you whether or not the sales team actually reached the prospect, whether they were qualified, whether they actually applied, or whether the campaign or that specific lead actually produced revenue. Right? The ad platform, or like specifically, the cost of the lead, just tells you, hey, how much you spent to actually get the lead, how many leads actually came in, and what that lead cost you. What you need to truly know is how many leads were contacted, how many were actually qualified, how many of those applied, how many of those were actually approved, and how many of those became customers. This is important because you could have 100 million leads, but if 0 of them closed, you'll have paid for 100 million leads and you would have made no money. You're not going to have a business. But let's say you got 100 leads and 5 of them closed. It's going to be a much different situation. You are going to evaluate that campaign based on the profitability and how much revenue it actually generated. Campaign A, 1 million leads, 0 sales. Campaign B, 100 leads, 5 sales. Campaign B wins every time, even though, it generated less leads overall. All right, so now let's go through a specific example in business lending. Talk about ad spend, leads, contacts, applications, approvals, funded deals, and revenue. Now, these are actual figures for these campaigns. So let's assume $12,500 in ad spend generates 100 leads. That means every lead costs $125. You've contacted 68% of your leads. That means that your sales team has been able to actually get in touch with and speak with 68 out of the 100 leads that submitted their information and inquiries for more. Of those 68 people, 25% applied. That means they've submitted their bank statements. That means that they've filled out a full application. I mean, 17 total applications out of the 100 initial leads. Then you have 47% of which are approved. So of the 17 applications, you get 8 approvals. And from here, you have 4% total funded rate. So 4 funded deals out of 100 leads. So as you can see, 12,500 in ad spend leads into 4 funded deals. So let's talk about this in terms of cost per lead versus cost per outcome, right? Total customer value. Assume you have a customer value of $15,000 and the cost to acquire the customer is $3,125. That's based on this previous example of 4% funded rate, $125 a lead. That means one of every 25 leads will close. Means you have a $3,125 cost to acquire a customer. Now, this LTGP to CAC, that means lifetime gross profit to cost to acquire a customer. This is a profitability metric. What I mean by profitability metric is this is your lifetime gross profit, or the actual profit that you're making on your customer relative to the overall cost that it is to actually acquire the customer. The higher this number is, the more you can afford to spend to acquire more customers. So the higher this number, the better, all else equal. So we have a 4.8 based on these metrics here. So let's compare 2 scenarios. We have ad A. Let's say this ad gets a $60 cost per lead, 7 applications in, 0 funded deals. Say this ad has a lead cost of $250. It's less alarming. It's less abrupt. It's less, hey, get started now, do this now. It's less desperate. That's going to cause a higher cost per lead. Typically, if you have a higher customer value, your lead cost is just going to go up. But again, you can see here with 10 applications versus 7, you're having slightly better efficiency in terms of the outcomes relative to the leads. That being said, the funded deals coming from this at 2 versus 0 means that this ad was actually successful in generating a real customer versus this was just getting tire kickers. Cheap leads, tire kickers. Ad B, more expensive leads, higher intent leads, leads that actually closed. Bottom line, cheaper leads in ad A, more valuable outcomes in ad B. So now let's just talk about what each market is tracking. We've already gone through this for the business lending side, but basically contacts, applications, approval, funded deals, revenues, and commissions. For debt relief, contacts, eligible debt, enrollment debt, and then cost per enrollment. Commercial insurance, contacted, qualified opportunities, quote, policies, premiums written. And the core thing here, campaign data and sales data, they need to tell one specific story. If the lead provider is only receiving the form submission data, the campaign can only be evaluated around lead volume and cost per lead. Now, once the buyer is able to work with the lead provider and shares deeper funnel metrics like the contact rates, the application rates, the approval rates, funding, enrollment, policy, revenue outcomes, the campaign can actually be evaluated against those actual customer economics. And that is how you decide whether a lead source should be scaled, should be adjusted, or turned off completely. So that's pretty much the process in a brief nutshell. If you are currently running ads, you're paying for ads, you're looking for more qualified leads that actually turn into revenue, we might be able to help you out. If you'd like to learn more, go to the first link in the description below. Hop on a call with us. We'll hop on a call with you. We'll discuss about your business. We'll understand your goals, what you're specifically trying to achieve. And if it's a good fit, we'll talk about how to actually get started. That's it for this video. I'll see you guys in the next one.